Welcome to everyone. Well, it's wonderful to be back with another webinar, and specifically in a sector that is probably my most favorite sector when it comes to investing, not only in good times, but in bad times. We're talking about the medical space, medical office buildings, as some people would call them, medical commercial space. In simple terms, it's property or commercial property or real estate with a focus on medical. Now, before we get into introducing our guest tonight and who we've got, I'd love to just see from everyone's perspective where you are coming from. It's always good to see that you're engaging, you know how to use the webinar. So there's a little button up in the top right corner. Tell us where you're coming from. And while people are telling us where we're coming from, I just wanted to welcome our guest tonight. I will give a proper formal introduction just now, but we've got Justin Clark, we've got Michiel Lucas, and Lee Rush, and Fritz all joining us. So wonderful to have you all online tonight and sharing with us what is actually happening on the ground in America. And just see my camera's got a bit weird as well.
Looks like you've grown wing, but.
There we are. I got rid of my haze. Okay, let's rock and roll. So I think we're in very interesting times. We all know what's going on, whether we see the press, sell-off sweeping through equities, shut down here, shut down there. We're all reading about it. I was on a webinar where someone called Roger Hamilton was sharing just a whole bunch of news articles, and rents are down 31% in America in the residential space. 22 million Americans have filed for unemployment. 1/3 of Americans missed their rent payment. Flights over commercial rents getting ugly. In home loans, 15 million mortgage defaults. The UN talking about the impact of job losses. In the UK, they're talking about the economy going down, unemployment in both of them. So it really doesn't matter which market you look at. If you want to follow the press, you're going to get yourself nicely depressed in terms of what is actually happening between England, Australia, and America. And I think really what I wanted to start with was something I learned many, many years ago is that in any time of crisis, people always focus on the right-hand part of the curve, which is really, this section here. And what they don't focus on is the fundamentals. And this is a sector where, the people that are joining us have been in this game for a long time. They understand it. And I really think that tonight it's important to understand the fundamentals. As Napoleon said, the right information at the right time is 9/10 in any battle. The purpose of tonight is to get the right information so that you can make the right decisions. From my perspective, where did it all start? Well, I did my first property development when I was 22, my first London property when I was 24. We've helped thousands of people invest into South African property, London property, Australian property, and American property, but it was all residential. And we realized that there was a huge demand for people that actually wanted to get into commercial properties. And that's when we launched the platform Migrate to allow people to participate in commercial properties. But if you come back to this graph, there's one thing that I just wanted to share with you, one quick story that I wanted to share with you, because I think it's very relevant for tonight. In 2002, when I bought my first London property, all my friends told me it was a terrible time. We just had September the 11th. England was going to war with Afghanistan, oil prices were going up, inflation was going up, etc., etc. And in simple terms, we bought this 3-bedroom house and we put 2 extra bedrooms onto it. We basically created a conservatory which turned into 2 extra bedrooms, and that allowed us to earn a passive income. And for 18 years now, this asset has afforded me to earn a very stable, passive and resilient income. And I thought that I was really onto something until in 2009, I actually met Henny and one of his business partners, Peter Fenstra, and I was fascinated because I'd helped all these people invest in residential and houses or apartments. And I remember saying to them, we were in Bondi Beach, Sydney, and I said, what are you investing in? And they said, medical buildings. And I said, why medical? And they said, because with all my degrees and experience and everything else, no one had ever taught me medical. And it was so simple. They said 3 things which blew me away. The first was that no matter what happens in the global economy, people need doctors. Secondly, doctors never leave their premises. And thirdly, doctors make very good doctors, but they're not accountants. And therefore, they sign very good long-term stable leases. So we'll talk more about this tonight. But ever since that day, I was intrigued. I thought, Michiel, you'd enjoy this picture. This was you and I back in 2012 exploring America. You know, in those days, that picture was in Australia, and we wanted to get into the American market, and we were still in the residential sector. Yeah, so we were looking at buying houses, and this was actually us walking around looking at medical office premises back in 2013, 2014. And just a shout out to Mandy Clark, who introduced us to Paul and Bruce. And I don't know if you can recognize, there's Dolph DeRus there, and Henny, and Paul and Bruce, etc., that were walking around. And that really led to getting into the commercial space back in 2014. And I think, you know, when one looks at Orbvest and what they've achieved with their partner on the ground, SG Properties, these two deals, what's really interesting is that they paid the return for more than 5 years, and they got an exit at the end of last year. So they've gone full cycle. People have been able to invest. They've not only earned the quarterly dividends, but they've also got the exit at the end. So it's a full cycle deal where people can see it. So when we're talking tonight, we're not talking about ifs and maybes. We're talking about a long, sustainable track record. And I tend to joke with people, but you know, we're going to talk tonight about Medical 27. So we've come a long way with our partners in Orbvest and their partners on the ground, from Medical 1 right through now to Medical 27. And I think just the last point that I wanted to make is that from a platform perspective, there's a lot of track record, but really what's important for our investors is whether they want to diversify around the world, they've got that ability. They don't have to invest millions of dollars anymore to be able to invest. In fact, they can literally get started with $100. And how does it work? Well, we go and find a partner like Orbvest, someone that specializes in a specific sector. So someone that specializes in medical. We don't try and be an expert in every market everywhere in the world. They have a building, and we're going to talk about Medical 27 later. You and I get access to those opportunities, and there's 4 simple steps upon which we can actually invest. And through the platform, what used to take years or even months can now literally be done in minutes. And the last thing that I wanted to say before I move on and we go into the information session is this is such a valuable principle of collaborative investing. You need to find local partners. And I know that Michiel tonight will talk a lot about the local partners. The second is you need to get them to invest. It's a really important principle. The third is that you've got to get them to believe in the model. And, you know, in the beginning, it was so difficult to get local partners on the ground to believe in the model. The fourth is that you need to have regular meetings. And the fifth is that you need to have two-way communication, which really is what, you know, tonight is all about. And so that's the way they used to do it in the old days. Now I believe that you can use technology. And so without further ado, I wanted to take that, which is all about collaborative investing and information, and pivot to our update tonight, which is all around medical. There's 2 partners that I wanted to introduce and have known for a long time. The first was Michiel, who is the Global Funding and Acquisition Director at Orbvest. As I showed you, him and I have walked a long road together, walking many houses in America many, many years ago. And funny enough, Michiel, I was looking at some of the pictures, including North Dakota, which was quite, with the oil price at negative. I'm quite glad we don't own a bunch of shopping centers in North Dakota. But had his background in Siemens and has an MBA and lots of qualifications behind him. So wonderful to have you online tonight, Michiel. And the second person is Justin Clark. He's the Orbvest Director of Operations. He was a previous chairman of One Media Africa and the founder as well, and also a brand that a lot of people in South Africa will recognize, which is Private Property. And then lastly, just some of our wealth consultants are going to be joining us tonight in terms of, you know, any questions that they've got or their clients, you know, that they have. But guys, that's the intro. So, you know, Justin and Michiel, it's really awesome to have you online tonight. Thank you for your time and joining us. You know, there's nothing better than talking to local partners about what's actually happening on the ground. As I said to you, we can all go and read the mass hysteria of what the press is saying, but we're not interested in that. We're interested in the fundamentals and what's happening. So, you know, thank you for joining us. We really appreciate it. And while you say hello, I'm going to try to get rid of why I'm suddenly all misty.
Okay, is this the hello? Are we doing the Queen thing? That's great. Thanks for the intro. While you're doing that, good evening, everybody. I see there's an amazing crowd online. That is absolutely fantastic because we love speaking about medical. We're going to break away from our normal procedure of putting up a very directed slideshow, starting at number 1 and ending at number 350. And we are going to just do it quite informally with some Q&A. I certainly hope that Michiel does put some slides up and show you a few things of this new Medical 27 building. But let's come back to what Scott was talking about a little while ago. Certainly in the very early days of WealthE Migrate, when he met Henny and Peter, Henny is a very interesting character in South Africa. He started doing medical buildings 37 odd years ago. Apologies if some of you are old investors and have heard of this all before, but he has an incredible track record, and he has been in the medical space even longer than that, and started off developing funds long before Discovery used data in order to be able to understand people's claims. In 30 years ago, medical insurance was exactly that. It was insurance. So they didn't have any data, and they didn't charge people different prices. You basically bought your medical insurance. So anyway, deep understanding of medical, and so yeah, you know, I think he is very influential in the way that Orbvest is focusing and hyper focusing, as we like to say, because medical is not just about a building with some doctors in it. As we have learned, you know, there is disruption happening even in the medical sector. And medical, let's just talk about that for a second. In the US, it's $1 trillion opportunity, so it's massive. But what medical buildings do you buy? And I think what is very clear is that this disruption is not only happening everywhere in the world with other things, but it's happening very specifically in the medical space. Think about it. When you're feeling you've got some symptoms, the first thing you do is go onto Google. So there's the first disruptor. There are the tech invaders, and that is the likes of Google and telemedicine. I've done it myself in the States, where you go online, you find an online service, and you consult with your doctor. You don't get in the car, you consult with him online. He sends a script through to the local pharmacy nearest to you, and there he doesn't have to sit in a building anymore. So once again, primary healthcare, we stay away from now, and on both sides of the equation. Also, at the other side, we have, and I must say, Michiel will smile here, because we fought very, very hard to get senior living, as it's called in the US, or care homes, and we got some senior living establishments in the US that were excellent yields and excellent returns. And thank goodness we didn't do them. Our investment committee effectively killed them because they felt that there was too much emphasis on one operator in that particular case. So, you know, there's lots of different components, and I think this talks a lot to where we are going with Medical 27 and where we're going in the future. So, you know, I think the other thing, Scott, that we need to say is that, you know, we've been saying for so many years that medical is fantastic and it will survive a recession, but nobody really anticipated that it would be faced with a black swan like we have at the moment. So our hypothesis has ultimately been tested to the death. So I think this is a very good...
And I think that's, you know, that's certainly where I'd like to start, you know, to get an understanding of what's happening in the market. Like you said, testing the hypothesis. You know, I'll never forget when those days when the pictures of Michiel and I, and we were asking people what happened in the last crash, and, you know, where residential property lost, you know, anywhere from 40 to 70%, you know, medical and multifamily were the two most economically resilient investments. And I remember asking the likes of Paul at SG Properties, and he said, you know, we didn't actually lose any tenants, but what I'm fascinated about, as you said, is it's a black swan, and is that still holding up? You know, so Michiel, you said you had some slides that were relevant. Do you mind if I share my screen to yourself and we actually see your slides? Because I think it's really important to not just talk theoretically and actually understand what's happening on the ground.
Absolutely. Well, Michiel is firing that. I'll give a little bit of insight into the US. We'll wait for your slide to come up there, Michiel. So, you know, the US obviously is further down the line than we are, so they've had a lot more infection and obviously a lot more panic. And certainly the two states that we have focused on up till now, Georgia and Texas, have been shut down for the entire period of March. So there you go. I think the one thing that's different from the US, we can see your slide. Thank you, Michiel. And yeah, I'll let you take over from here because you've got your slide up.
Yeah, so Scott, just quickly touching in what we've seen, obviously, the unemployment spike, which you saw or referenced earlier. I've just got the starting point of that spike. It's really went up. What we have seen is I think it's over 30 million already. And what we know from the US is that they're absolutely resilient in terms of their flexibility and fluidness of their labor law. It may be a good thing, also potentially a bad thing. But what we've basically seen in our main markets, Texas and Georgia, is that they have opened up the market. They've applied huge stimulus packages. Guys, this is unbelievable amount of money that people can get from a small business perspective, really to support your, let's call it your payroll, and obviously a huge testing and screening exercise. So that's what we've seen on the market. But what I wanted to just quickly go back, sorry, let me just get here. Quickly want to go back. This is what we've seen from the data in the GFC. And Scott, remember when we spoke to SG and the boys, this was a little bit before our time, and that's what they've seen. Medical is affected, but it's not as affected as much. And what we have been looking very specifically at is...
also, sorry, can I just point out one thing? Because your slide's showing that it depreciated in terms of necessarily the value. But if you're still getting paid your income during that period and you ride the wave, it doesn't necessarily affect you. And that's why I tried to start with the story of my house and the story of this picture behind me, because it's such an important mindset of resilient income producing assets during tough times.
Yeah, no, Scott, I think that's really what we're all about. We're really focusing on the income. I think everybody that knows a little bit about property understands that capital appreciation is a fleeting concept, as we call it. It really boils down to the income. And what we've seen in our markets is that we don't lose tenants. We pretty much ride that through. And I think this is the slide, Scott, that I've been referencing from our portfolio. As you can see, you can recognize some of the earlier deals. And this will give you a picture that in the month of, let's call it March, mid-March, when we started to see the actual Black Swan event happening, we found that roughly about 4.7% of our tenants started to say, listen, I cannot make it. As you can see, roughly 21 out of the 146 tenants that we're busy with. And basically what they said, listen guys, we just need a bit of a break on my rent for the month of April and May, and we should be pretty much fine. We will not write it off, but we will pay you back. And that's exactly what happened. And what we have seen, as you can see, our first month, we actually got an actual of about a 4.7% impact on the income. And then what we're projecting pretty much now, we're just checking in on those figures, but we expect a little bit more. But as you can see, all of a sudden in June, our current projection shows that it's just jumping back. So, you know, Scott, if you compare this income to some of the other segments that we are aware of, specifically the hotel sectors, you can just think of it. They basically got second to zero type of income scenarios from various projects that we understand. And, you know, it's quite logical. People haven't been traveled. So that's just one example. So here it's just another show that the income has been quite resilient.
Sorry, the connection is not great, so I don't mean to talk over you. But actually that one slide I've showed you, or that one report I showed you, was that 86% of retail tenants weren't paying in America, so not worldwide, in America. 31% of residential tenants, and obviously multifamily has been hugely resilient in the previous crash, but in this crash, you know, there's a lot of government stimulus coming in. You know, as you said, the tourism industry has literally fallen apart. I mean, if you own a building and you're trying to use Airbnb, it's a joke. And then finally, you know, so really there's only a few sectors, you know, medical, logistics. I mean, the office space is equally in trouble. So, you know, it's really interesting watching different sectors around being future-proofed in this current market.
Yeah, and Scott, if you think of it, what we also found is when you, I'm just going to go a little bit to the different types of real estate. Let me just jump a little bit back. I just want to talk a little bit about this. And this is to your point, is that the segments that we see is obviously the hospital segments. Interesting enough, the hospitals on the ground has actually been a little bit avoided because they feel that people feel there's a high concentration of risk at hospitals to actually get the virus. So what we have found is that when procedures can be done at the hospital and at the medical office blocks, the red segment, which we've been focusing on the whole time, people actually prefer to come to the medical office block. So that was on some of our tenants, we actually saw an uptick in the activities. Some of our tenants, which we alluded to, were like the dentist and some of the primary care. They were simply shut down by virtue of the law, like non-essential operations. Thank you, please stop. And that's where the tenants, which we had the rent deferment came from, is really the source of that. And then the other sectors which Justin alluded to previously is in terms of the senior housing. We also found that the seniors were obviously very, susceptible to the virus. So there was, fortunately or unfortunately, also a lot of issues around this. And then the sector that we're pretty bullish about is the inpatient rehabilitation sector, or basically just let's call it the phase after your hospital phase. If you had a serious accident and you need rehabilitation, this has really been such a vibrant sector because you can't shut that down. It has to continue. And then the newest sector that's coming along, which is a little bit in the future, is the life science, etc. So I just thought, just to put it a little bit more practical on, what tenants is actually now really functioning. It's really the surgical centers, it's the laboratoriums. We've got 2 or 3 labs that's now producing the tests. And then the sectors or the type of tenants that really has been a little bit affected, but not catastrophic, is the primary care and the dentist, and they obviously are getting back. Both Texas and Georgia has reopened the borders. New Jersey and New York obviously is still closed. So they've also got a bit of a phased approach like elsewhere in the world.
Tell me, just in terms of, you've actually answered one of my questions was, with medical premises, as an example, I can't go see my physio because they shut down all my dentists. So you've already answered that question in terms of the impact that's having. My second question is in terms of the overall space and not only the short-term impact around the next 2 to 3 months, but where do you see, Corona and COVID, what do you see as some of the structural changes that are going to take place in America and in the space?
What we have definitely seen is that the lenders are definitely, we've got mixed reaction on the lenders. So what we've seen is the CMBS lenders, they've really closed up. We also see some constructions had been delayed purely because you can't get building permits. So from the initial, let's call it shock, we've seen that immediate reaction. What we are anticipating is that there is definitely doctors that hasn't had the cash flow that could potentially be in trouble. That would also be potential acquisition targets. So not all is well if you're not fully or properly capitalized. So from our perspective, we actually see that from an overall perspective that there is also an influx of equity or capital into the medical segment. For those that doesn't know, about 5 or 6 years ago, you basically got retail and office and obviously industrial as your main segment, and medical wasn't actually seen as a fully fledged segment. But recently, because of the stable returns and the resilience of the medical industry, it's become a fully fledged segment. And so much so that we now starting to see quite a net inflow of capital into the healthcare sector. Because, Scott, if you think about it, where does investors actually go? On the one side, traditionally, they had the chance to stay in the stock market. yes, the stock market is a roller coaster. I don't know what's going to happen, ups and downs. So people feel that they might need to get a little bit out of the stock market. But if they then go out of the stock market, they go into the bonds. Yes, the bonds value is increased, but their, let's call it, the interest rate is virtually zero or potentially go negative. So the only real segment that's left is pretty much the real estate segment, and a favorite segment is the, let's call it, the closed-end fund opportunities, which we are presenting here tonight with yourselves on your platform, where we're not listed, we are listed on a stock exchange, but it's a closed-end fund. So we don't correlate to the stock exchange, yet we still give an income. Yeah, so from that perspective, we've definitely seen capital movement out of the equity markets into the property markets, and specifically, there's been quite a nice influx into the healthcare.
So there's an article here. I was doing some research today, and I'll give you the slide back, but I just thought it was pretty relevant based on what you were just talking about. And literally, MOB's medical office buildings should provide the lowest level of risk in the event of a coronavirus sparked recession. And it actually talks quite a lot about all the different things, and some of the largest real estate companies, including CBRE, etc., are just talking about where it's at and what's actually happening. So that was one article. And there's another article here about medical office buildings poised for quick recovery. Now, both these articles were from April. So, you know, it's not stuff that was pre-corona, if you want to say that. And I just thought pretty relevant for what you're talking about. So I'm going to give you back the slides. I don't know if there's anything you wanted to share. There was a question I wanted to ask quickly. Are you concerned about the government amendments and sort of cutbacks in the healthcare sector? And, you know, obviously, Donald Trump, you don't know what's going to happen from one tweet to the next. But, you know, where is sort of government policy going? And I know that obviously you've got federal and state, and specifically the two states you've spoken about. Where do you see that happening?
Yeah, Scott, we kind of like the situation in America at the moment. What we've seen is that roughly about 91 to 93 of the population has got private medical insurance. And then it is by law that you have to have Medicare if you're over 65. The changes that Donald Trump made to the Obamacare is really on a very small segment of that sphere. So from our perspective, the fact that the Senate and the House is pretty much in balance and they can't do too much means that we don't get too much changes further here in the, let's call it, the Obamacare or the Medicare, Medicaid scenario. So from our perspective, the tenants, clients, which is the patients, are really similar to South Africa, predominantly private healthcare and not national healthcare like in other countries. So from that perspective, it just bodes well for this industry as a whole. And then further to this, obviously Donald Trump has made a lot of tax changes, and the tax changes has really favored real estate. And as a result of that, also the changes in the fact that the interest rate has halved. Scott, I don't know if you remember about last year when we did a deal in Austin, we were paying like just over 5% interest, and this time around we're down to 3.15%. So yeah, two major things has happened is the tax efficiency has increased by virtue of the Republicans. The Obamacare has not been changed too much, but in fact actually strengthened in certain areas. And then lastly, the interest rates as a result of the Republican policy. One can argue about that, obviously positives and negatives, but from a pure practical on the ground numbers, we just have a phenomenal additional gains because of the lower interest rates.
Yeah. No, that's I mean, it's fantastic. And just in terms of your premises, the portfolio that you showed us, you know, currently, whatever you said, 4 to 5% of people are struggling to pay at the moment. What would be the contingency plans, you know, should that continue? As you said, like it's coming in June, and you know, from an investment perspective for investors, what are the contingency plans should that, you know, go on for longer?
Yeah, Scott. So A lot of our deals has got inherent buffers in it. So I think that is the first level of defense. Some of the deals that we did later and also the bigger deals, we kind of anticipated there should be coming a correction. So we started to decrease the leverage on the senior debt level. So it means that we've got lower leverage and we've got capacity to ride through. And then lastly, like you know from our perspective, is the number one objective for us is obviously capital preservation. And secondary is obviously if we can make a nice profit. So worst case scenario, we can, let's call it, dial down on the income or the dividend distribution so that we can simply maintain to pay the bond. And that's really where we move to really to the extreme side. So what we have been doing has been very proactively working with the tenants. All our property partners has secured senior or small business loans, as they call it, SBA loans in the United States, which effectively supports payroll. And this expertise has been offered now to the tenants where they can support their staff. So the whole focus was really to get into a collaborative mode with the tenants, help them to help themselves so that we can get back on track. So I hope I explained the levels of actions we can take, but the first level is really just to see where we can help them to help themselves. And then as a second level, postpone the income, but not write that off. And then thirdly, if it really starts to bite, we can lower a little bit of the income on the project with the understanding that that gets caught up later in the year. So that's the prognosis. From our perspective, the view from the tenants is really that things are opening up again, definitely not out of the woodworks, but I don't see it continuing for a year or two. I definitely see it as a short-term 3 to 4 months, maybe 5 months effect, but definitely not a year effect.
And I think just a thing to point out there, and I've been an investor in the medical buildings right back since Medical One, and one of the thought processes that goes through my own head is that even though a dentist has not been able to work, the moment they open for business, they'll have clients. people need to get their teeth fixed, Whereas, if I'm a yoga instructor or, I own an office space or something, or, a retail store, or a restaurant, when it opens up, I might be bankrupt and have no capital, and it's the end of the game anyway. And I just think it's an important mindset to see the psychology, which is different between the two. Justin, this might be, I've got 2 more questions, and then I'd like to pivot to talk about Medical 27. Sorry, Michiel, did you have something to say there?
Yeah, I think, Scott, when there's discretionary surgery or dentistry to be done, yes, you postpone it because it's now a short-term effect, but the fact of the matter, you must still do it. And that just plays to your point,
Very much so. Just a question maybe for you is, in terms of Orbvest and what differentiates you, is that there's a lot of capital coming in, as Michiel said. 10 years ago, no one had ever heard of medical, including me, back in 2009 in Bondi Beach, and now obviously it's all over the press. A lot of people are talking about it. Many of us have been talking about it for a long time now, and there's a lot of capital inflows coming. So how will Orbvest not only remain sustainable but competitive in this market, not just at a global level, but more importantly at an American level, to ensure you continue to find good partners and good deals?
That's a great question, Scott. And I think the first thing is that, listen, we think that we're huge because we've got whatever $300 million under management even after the sale of 1 and 2. But the fact is that we're really, really small in a $1 industry. I've got a bit of echo. That's not a problem. Where it's coming from. Someone else has got their mic on. So yeah, I think there's the way that we have is we have to become hyper focused. That means that can you hear me? It looks like you guys are battling a bit there. We have to become hyper focused and just get better at the medical speciality. And that's what I was saying in the beginning. We need to get much more focused on what the best performing components of medical are and build a reputation. So the one thing is the components and the focus, and the other thing is the people. We need to have a bigger team, and in fact, we are effectively doing a migration to the USA, because you can't be sitting at the tip of Africa operating in the USA. So I think those are two things that are important. And differentiation also means, you know, if we want to play and become a major player in the US, we have to bring in the necessary skills from the US. And we are in the process of appointing a whole bunch of directors and committee members from the US that are experts in the space. So yeah, to answer your question, there's only one way that you win, and that is make sure that you are focused in the States and deep in the market.
So sorry, I'm getting muted here as well. So I just said excellent. That's very clear, and I love that. And I remind everyone that, you know, one of our 3 core things that we look for in a partner is focus. Because again, if you're trying to do everything in a jack of all trades, you're not good at anything. So it's awesome that this is the sector that you specialize in. And again, why tonight we wanted to talk to you guys and understand what's happening, because this is your speciality and your focus. My last question, and then let's pivot into the new opportunity that's coming. And I'm not sure Michiel or Justin or both of you want to answer this, but you know, I believe that COVID is you know, the global recession was happening anyway. It was just a matter of time. We've all been talking about it for 2 to 3 years. Every pundit has been mentioning it, and it was like a balloon, and COVID was just the pin that pricked it. But what it is doing is it's creating a societal change. It's creating a fundamental societal change. You know, there's something like 70% of office workers have said they don't need to go back to their office, et cetera, et cetera. So not looking 6 months ahead, maybe not even looking 2 years ahead, but let's look 5 to 10 years ahead. Where do you see this space going? And do you think that COVID will just be a blip, or do you think it could have a catalytic impact, good or bad, for the medical sector and specifically these MOBs?
Yeah, I'm very glad to say that I think we're still in the right space. It's Warren Buffett that said that if you're investing in something, invest in something that's valuable in 10 years' time. And I think that is absolutely the focus that we are trying to make sure that is instilled throughout the business. So, and once again, it's the reason for us hyper-focusing and getting into sectors of the real estate market, of the medical real estate market, that are going to be much more valuable in the future. I come back to what I said before, Scotty, and you know more than anybody, the disruptors. Everybody is not safe, because this COVID, well, we're not meant to say the word, I guess, the rattling cough, this problem has changed the world, and it won't be the same again. People are going to operate a lot more from home. It's going to be a very interesting place. There's going to be less demand for office buildings because people don't need them anymore, because they've realized, they've been forced to realize that you can actually operate remotely. So how does this affect medicine? Well, it doesn't, because unfortunately, when someone's got to chop your leg off and replace their knee, they can't do it in your home. So you have to go to a place that's equipped for it. The other thing is the technology and the way that or the population growth of people above 65, and we haven't touched on that. So we know, and we don't have to share the graph because it's very obvious. In the US, there is this massive balloon of people over the age of 65, and the fact is that people that are over the age of 65 need to spend 5 times more on medical than the group below 65. So, you know, that is,
Yes.
are you going to...
Sorry, I'm listening. I'm actually just trying to find your graph for you.
Okay, yeah, no, well, I got it to you if you want it, but you know, I don't think we need to go to it. I think it's so what is happening with technology is we effectively are moving from this dispensation of sick care to healthcare, and healthcare means that somebody won't get cancer in old age or Alzheimer's, because we'll make sure that they don't, because we'll anticipate, we'll do genome sequencing, and we'll fix it before they get the disease. So ultimately, you're going to get a ballooning of much older people, and much older people need more medical. So the demand isn't going to go away, and I still say that the investments that we're making today for 5 years, we're going to be very loath to sell them in 5 years' time, because they're going to be more valuable, and that's very important.
Yeah, maybe
Awesome.
just to add on to that, the distribution from the population distribution from young to old people is very sound in the US. So the older generation is not a top-heavy portion of the US. Matter of fact, it's roughly about 23-24%, compared to other parts in the world where it's like 30 and more than 30%. So what we also see over and above that, people are now starting to live longer, the segment, the older population segment in the United States is still not at 25% or a quarter of the population. So just that movement alone is another 50 million people, and 50 million people translated into medical facilities is really a lot of scope. So, matter of fact, just before the corona impact, the actual change in the market has been that there's been a huge movement towards actual development of facilities because the existing stock has really been taken up. So just to support Justin there, there's a huge wave coming both from the population growth and the conversion of technology, helping people to stay younger longer.
No, fantastic. Well, I've put a poll up just for people's interest sake, because obviously we've been talking about the sector and medical office buildings and whether people like the sector or whether they need more information or etc. in terms of where it is. While I've got that poll up, and I'm challenging you all to get your votes in, what I'd like to do, Michiel, if you can get ready, because what I want to do basically is pivot now. And if I share my screen quickly, I just wanted to go to the Wealth Migrate marketplace, and you can actually see that this is the building that we're going to be talking about. And we're very excited because it's, oh, hang on, what just happened there? I got logged back in again. But we're very excited because it's literally launching at the moment in terms of where we're at. And so if I go back down to the deal, and what Michiel is going to do now is actually take people through the information. You'll be able to see it all. I unfortunately can't invest yet because my portfolio is still being KYC'd. Never been very good at admin, as Michiel would know. But anyway, so this is all the information is here in terms of the documents and even their brochure, that the Orbvest brochure with everything. And this is actually where Justin, I was going to bring this up for you, where you've got the segments and the aged people, etc. But I don't want to go through this slideshow because you've got a better one in terms of your actual slideshow. So I'm going to pivot back to you, Michiel. I just wanted to show everyone where they can find the information that is already live on the platform.
All right. Thank you, Scott. I think to understand this opportunity, we just have to quickly just jump in onto this, not this slide. We just spoke about the change from sick care to healthcare. It's more going to be preventative for that matter. But I really think this is a quite important slide. I alluded to the additional segment, which is called the inpatient rehabilitation segment. And you can see acute care hospital is what we normally just call a hospital in layman's terms. And, if you have a serious operation and you have to get care after the hospital, you obviously can go get it at home. But normally it's not so easy. Sometimes you are very old, then you have to go to the hospice or the skilled nursing facilities. Or if you've got some really, really serious stuff, you go to another hospital, which is just a long-term hospital. Or you simply, if you can't afford it, people go to home care. But what's interesting is this segment in the middle here is called the Inpatient Rehabilitation Center. And I'm going to speak a lot about that tonight. I think it's fundamental to understand that segment, we view that as a very least disruptable segment in terms of technology. Yes, it will definitely get technology, but the fact of the matter, you still must physically undergo this therapy, and that makes it so much resilient. So for those that doesn't know, we've been focusing on the MOB space, and this opportunity is really our first dip into this new segment, which is what we call the post-acute facility or after hospital facility, and that's where this is positioned. Right, so this opportunity we are introducing as Medical 27. It's an opportunity that we've launched earlier, about a week or two ago, and it's really focusing on buying this inpatient rehabilitation center in Texas. We need to raise roughly about 8.7 million. I'm going to go into the details just now, but I think I want to get to the core and the gist of this opportunity. First of all, it's in Texas, and from our research, Texas has been one of the most resilient states. They are by far the fastest growing state in terms of population growth. They and Florida is really getting the bulk of the influx of people migrating in the United States. And the whole Dallas-Fort Worth area per se is an absolute buoyant area. We also have got a co-partner on the ground, Lincoln Harris, huge company that's really assisting us, is in their back home yard. They are managing more than 730 buildings. They're the partner that's signing for the debt. They are co-investing with us. They got skin in the game. So we're very happy to be a co-partner on this project. But really the big thing about this is the Encompass Health.
Sorry, Michiel, just one thing, if you don't mind. I just want to highlight a few things. Your partner is not only a very large company, they're also on the New York Stock Exchange, just to put it in perspective. And they've got 133 inpatient facilities, and they're in 37 states in America. So as you said, it's in their backyard, but they didn't start last week.
Yeah, so what you're referring to here, Scott, is the tenant. That is our tenant, and our partner is Lincoln Harris, that helps us to manage on the ground. So in this specific case, Encompass is listed on the stock exchange. They got a Moody investment grade Baa3, and like you just alluded to, they've got 133 inpatient facilities. This is a triple net lease, and it's actually a little bit more than a triple net lease. I wish I can add another N to it, because this $43 per square foot that we get is for the facility that they are renting from us for outstanding lease term of 13 years. It's an absolute triple net. That means that we don't even have to allow for maintenance or capital expenditure. It's an all-inclusive triple net. So from that perspective, it's very important that we really look at what this tenant is all about. So this tenant is by far the largest operator of these type of facilities in the United States. If you look at it, 133 facilities to the nearest competitor, which is in the low 20s. So from that perspective, this is the dominant partner. Also in this sector, I alluded earlier about the Obamacare and the Medicare payment system for this. It's fully done through these systems, and what's important is that these systems are outcome based. So it means that if a patient has to come back, the hospital actually will lose from a monetary perspective. So it's actually one of the good examples where business and health is actually fully aligned, and as a result, they've got all the incentive in the world to give you the best possible treatment so that you don't come back, and that's in their interest and your interest. So this is a very nice example of that, and that's why we're so excited about this opportunity in this time where they are fully operational and they are really the best in class from that perspective. So yes, just a bit of a glimpse what they do. They really rehabilitate people after major surgery, after major life events, where people really need specialist help. And they've got something like 20, 30 types of programs that they are doing, and also quite specialized programs. And most of the services that they offer to patients is something that you really can't replicate at home, or with a nurse at home, or really in other facilities. So it's actually a hospital that is rigged to really rehabilitate people that needs to learn to walk again, people that needs to learn to talk, to just do life again. And this is the type of services that these providers do. How does it look on the deal side? The deal is about 37 million. You'll see that we've got two loans. The one is a senior debt, and we use the ground lease facility really to rent out the ground, or we actually rent the ground back, and that really helps us to unlock the capital stack. This ground lease cost is much less than equity, so as a result of that, we have to raise less equity, and therefore the efficiency in terms of what we can put through from the deal towards the investors is enhanced by using this ground lease. And also what's interesting about it, the senior debt lender, in this case it's Siemens Financial Services. We secured a loan at 3.15%. It's already pretty much approved, and the rent is really covering it almost 3 times. So it's very, very strong financials from that perspective. We are raising 9.2 million equity, of which the Lincoln Harris partner executives are contributing some of their own money into the deal. And like always, we have a hurdle rate. We can invest from 5,000. I'm pretty sure with Scott's help, we can bring that even lower. And then the normal splits that we have above the hurdle is 50, 25, etc. So just a bit of a thing, always we have to talk about the risks. In this specific case, we can talk about the tenant risk. I've alluded to that there's a long-term, a 13-year lease in place. We're only going to plan to be in the deal for 5 years, so there's about 8 years left. Interest rate risk is a fixed interest rate at a very low rate. Valuation, absolutely in the prime spot in Texas, so we really believe that's a buoyant market. And the ground lease just helps us with the amount of finance that we have to regain when we sell the property, and also help us to make sure that our equity is lowered and our senior lender are pretty much in place. They don't try any tricks, because obviously if they don't pay the ground lease, then the ground lease can take them to task. So it's actually also a mechanism to keep our senior lender in line. So really a nice structuring method that we've learned from our partners over the years, and we've seen that's really tested, tried and tested in at least 2 GFCs from our previous partners. So this method has really been tested before. So from that perspective, Scott, like you can see, the cash flow is pretty solid. It's not 5x, sorry, it's 3x there. And best-in-class operator, triple net lease with no capex or maintenance. 5-year plan, got another 8-year lease remaining from the tenant. So the next guy has some skin on the, has got some profit that he can still make. So from that perspective, I think it's really been quite a nice found that we can do this type of deal in this environment. Quite interesting. We started off in December, never anticipating anything like this. We did expect that there could be a market correction in the United States, but obviously we didn't have the crystal ball to see this from a black swan perspective. Yeah, Scott, so that's just a quick glimpse of the deal. I don't know if you want to maybe open it up for a bit of questions, or if you guys have questions from your side.
No, very much so. What I do want to do is, I realized while I was showing you my screen that I actually wasn't showing you my screen and it was frozen. So I don't know why technology is playing games tonight. But I'm just going to steal back the screen, Michiel. What I was trying to show people is that if they go to the marketplace, and basically this is what I was trying to say with my KYC, because I've got to update my KYC because we've moved to the French regulator now. And so basically all the deals and the details that Michiel was talking about. And then what I actually went to this brochure here, and you can literally click on the brochure, and it literally opens up the full medical brochure that Michiel was basically showing. Oh, come on, am I still not showing my screen? Having one of those nights. Okay, let me try for the third time to show you what I've been trying to show you. So effectively, can you see it now? I just want to check. You should be able to. And
yes,
so this is what I was saying here with the French regulator. And anyway, so all the deals, all the details are here. And then if you literally go down here and click on it, you can actually get all the documentation that Michiel has been referring to. And just as an example, if you open any one of these slides, you can get the full breakdown from Orbvest, everything that Michiel has actually shown, the breakdown of the deal, the key facts within the deal. And this is also interesting. This was the part Justin was talking about, why investing in inpatient rehabilitation. So it's all there in terms of the different areas, etc., which is really interesting. We've got the location, and everything that Michiel has shown. So I just wanted to point out that for people that have been watching your slideshow, Michiel, it's all here. They can go read it. They can read through the financial summary, the breakdown of the site, and here's the financial summary that you were referring to and showing everyone. So all the information is there for people that are interested. So yes, let's pivot quickly to some questions. And I think one of the things that probably, certainly from my perspective, with my experience in this space, is that this is probably one of the stronger tenants that I've come across in terms of people actually being able to invest. We often talk about A-grade type offices and dealing with blue chip tenants, and it's certainly in my experience it's one of the first where we're coming across a listed company with this type of exposure. The question from an investor's perspective is, why would the seller be selling if they've got a tenant in place with a 13-year lease still on the cards, etc.? What's the reason? Why are you being able to pick up this asset?
Yeah, Scott, what has happened is that this lease was originally actually 23 years long, so there has been already some time on it. The previous, or the seller at this point in time, is a very large fund, and the fund tend to have these cycles every 5 to 6 years, which they cycle their portfolios, obviously to maintain their deal flow. And what we understood from them is that they are simply repositioning their portfolio, they're changing, and as a result, this is a portfolio change that they're doing, and that's why we picked it up.
Brilliant. So I want to, there's a bunch of questions here that I'd like to pivot to in terms of people in the room that have got questions. So Lee, would you mind running through some of the questions? I want to bring up just a slide while Michiel, just to show what Michiel was talking about, because it's something we've spoken about for years. And what ultimately happens with these funds is that it's not necessarily based on the quality of the deal. And we talk a lot about the value chain of real estate and how you want to be investing up the value chain of real estate. So I don't know, Lee, if you've got a question for us there, and then I'll pivot back to the slide once I find it.
Yeah, no problem. Hi guys. Do you foresee that the surplus in office space could be repurposed as medical space, causing an oversupply which drives down prices?
We have seen that the medical space is actually in dire need of additional space. So what has happened is that the medical developers have started to develop additional space. And what we do see is that a lot of the space are at specific locations that's not necessarily office location. We found that the medical starts to cluster into campuses. And if you think about it, if there's a major office block in downtown, whatever downtown, it's not necessarily going to be simply a good location for medical. Yes, there is potential to change to medical. However, the amount of money that you must put into a building to change it from an office building to a medical is quite high. So unless you can buy the medical building really cheap, the office building really cheap, it doesn't bode well for you to do that conversion. So I think that's the one side of the question. The second side of the question, or the answer to the question, is that the market is so large, and we're talking about $1.2 trillion in terms of real estate. So just on the medical sector side. So for one sector to dominate another sector in such a large market it's virtually impossible. So my answer here is very clearly no, it's not going to be happening.
I'm going to throw my 2 cents in as well, Michiel. A couple of things. First of all, it's not so much about the GP or the dentist to a less extent, because the dentist is also a setup cost. But there is also a significant amount of investment in the people that we actually want. And remember that this is a synergistic relationship. So you can't just put a doctor into a office building, because the doctor needs the specialist, and the specialist needs the surgery center. The surgery center needs the imaging. And what is very clever about our partners and the way that they operate, if you look at Medical 25, which you guys had on the platform, Scott, I mean, the average leases there is 17.5 years. How do we get 17.5 years? Well, the doctor's sitting in his hospital environment, which is most of the time where he's at, wants to move out, but he doesn't have the capital to set up his equipment and set up his rooms and have the necessary lead walls and three-phase power and all that he'll need. So we approached the guy and we agreed to take the capital cost of setting it up and add it to his TI. And the TI is a term that we use for the setup costs of the tenant. And so we managed to lock them in for long periods of time, and we spend that money on their behalf. So I think that's the one thing. And the other thing, Michiel, is the certificate of need. You can't just pop up and start practicing medicine. You have to, and for many of the specialities, you have to actually apply for a certificate of need that you can practice in that particular area. So that's two other very interesting points.
Thanks, Justin and Michiel. With oil prices at
Sorry, Lee, just quickly, I just want to add to Justin's point, because that's something I learned 5 or 6 years ago, and just explaining what Justin's saying is that we would buy a building and it would have people who were doing x-rays and stuff in it, and the license actually stayed with the building, not with the doctor, and there's only a specific number of licenses in an area. So yes, you could have an oversupply of office space, but it doesn't necessarily warrant or can become a medical building. And I think I'm just reiterating, Justin, what you're saying, because it's so important, and that's why, if you remember right in the beginning of this conversation, I said doctors never leave their premises. It's for all the reasons that Justin and Michiel have said, including the fact that people get used to coming to their location, so they don't shop around for space like other businesses do. And I just think it's so important to understand that mindset. And if you think I'm wrong, think back to when you were a child and think about the medical premises you went to, and I virtually guarantee you to this day they're still medical premises.
I must make another point. We're spending too much time on this one thing, but it is very interesting. And on the last trip that we did this time last year, well, that I did with Michiel, we went into one of the buildings and they had a CAT scan machine there. And the guy said that the only way that you can move that CAT scan is actually breaking the wall down. But the problem with breaking the wall down is the dust damages the machine so much that you can't, effectively, you're going to destroy the machine by moving it out of there. And those are the things that people don't realize. And once you're locked into that building, you're locked in.
I just want to share very quickly, Lee, before we pivot. I just want to take what Michiel said, because it's such a good example of what we've been talking about, is that if you take the value chain of real estate and where most people get to play, it's the funds and REITs that come in and buy these assets and, tend to want to just pay people cash flow. And I always say to people, why don't you go up the value chain of real estate? Why don't you invest at this level? And because most of us only get to invest in the listed sector. And really what Michiel said was why they're selling. Well, there's a listed vehicle that's hit a 5-year, 6-year mandate, and whether it's a good investment or not, they're selling it. And that's really what the opportunity lies. And really where technology, brings you, this opportunity is that you can now go up the value chain and you can literally invest, cutting out the middleman, and invest directly and partner with Orbvest in the deal. So I just wanted to visually represent what Michiel was saying. And just by the way, in terms of the exit strategy, our exit strategy will probably be to, and ours being with our partners on the ground, will obviously be to exit it to a fund or a REIT, because that's how most people make money in real estate once you've got a seasoned rent.
Scott, this talks exactly to why you set up Wealth Migrate in the first place, because it's these sort of buildings that us as average investors, even if you've got $1 million, you're nowhere. You're not going to be able to get a foot in the door yet. So it was previously completely inaccessible to the average investor. And this sort of building, especially because it is absolutely a piece of gold. It is a coupon clipper. I love that term that they call in the US, because you get your share in the building and you just collect your money. The risk is very, very low. The chance of a Baa3 tenant going bust is the world will be in a terrible position if those sort of companies have gone bust. So these things we never would have access to normally. So if you're a small investor, and I don't mean $5, I mean you can be a couple of $100,000 or $1 million investor, you still can't get a look at these sort of buildings unless you go through something like Wealth Migrate.
Well, on top of that, Justin, I'd actually venture a guess and say a lot more than $1 million. I think if you had 10, 20, $50 million with no track record, you wouldn't get access to the type of partners you got on the ground. It just doesn't work like that. So, and trust me, it took us many years of trying to find, the right partners, etc. So, I think the point being is that exactly that. It's not about whether you've got the money. It's whether you've got the knowledge, the access, and everything else. And the beauty is you can go try to do it all on your own, or you can do it with better partners. And as Michiel said, one of the things you've got to take into account is that even if you had $100 million, you wouldn't be able to get financing in America as a non-American citizen at 3.1%. I guarantee you wouldn't. And therefore, when you start looking at the returns and everything, it's what makes the cash-on-cash return so attractive. Lee, back to you. Sorry, I stole your thunder.
No, absolutely. It's a great banter that's happening. With the oil prices at historical lows and expected to stay low for the foreseeable future, do you still expect Texas to continue to be as vibrant as when you did the due diligence on this property? I'm sure you get this question all the time.
Take it, Michiel. It looks like you're muted.
I'll unmute him.
Do you want me to take it? If you have a look at the brochure, I think that one of the investment criteria that we had, and Scott alluded to early on, we do not go into a place that's over exposed to one particular industry. I think that we require 10 different industries to be dominant in that particular city before we invest in that city. And one of the reasons why we really like Texas is we really like Texas. Here we go. I think you're getting to the book. But yeah, some of the companies that are coming into Texas. What is so exciting about Texas is that not only is the population growing in the region of 14-odd%, correct me if I'm wrong, but all of these major companies in the US are setting up there. Why? Not necessarily for oil, it's because it's a tax-free state. And that is very attractive. If you're running a massive conglomerate, you want to be in a place where you are not taxed, you are taxed. So, there are some of the companies that are building massive establishments, massive campuses within the Texas area. Yeah, I don't think I have to add anything more to it further than that. I think, Justin,
I think the only thing I would say is that to think that Texas is only about oil is actually slightly naive. As an economy in general, and what's also really important in Texas from a medical perspective, is that they've actually set a cap on medical insurance at $1 million, and so there's a tremendous amount of medical that's come to Texas, and people can come and they can, they might live up in the cold, snowy areas, and they can come down and do their medical. There's a whole bunch of reasons. Hilda Lunderstedt, that's one of the larger investors in Orbvest and Migrate, has immigrated and lives in Austin, and she doesn't run an oil well. So my point being is that it's becoming the second biggest tech capital outside of Silicon Valley. So I mean, everything that you've said, I would go as far as to say anyone that thinks that Texas is about oil really should go and check out Texas. It's an extremely exciting state in general.
Yeah, Scott, where they should be going is to North Dakota. That is where oil is really all about. And one of the things that we did as a result of our lesson learned in North Dakota is not to focus on one-horse towns, and specifically as part of our due diligence going into Texas, we want to be in at least a diversified metropolitan like Dallas-Fort Worth with at least 10 to 15 different types of industries. And when you analyze Dallas specifically, you'll see that it's well diversified. Interesting enough, Houston,
sorry, Michiel, I'm going to take this picture off because I'm not going to leave it up for long. But this was us in North Dakota. Trust me, we know about places with oil. And I'm just very glad we're not a heavy investor there.
Scott, yeah. I think you need to fix your pictures. It looks like you ate too many Texan steaks when you were there.
Listen, it wasn't only me. Look at Michiel, all of us, all good South African boys that enjoyed a few steaks. So I did find another picture. I'll talk about that tonight. Of how much Sorry, Michiel, I cut you off.
No, I'm just saying it's a photo problem. So Let's get the next question.
What do you mean exactly by ground lease implication risks?
A ground lease is that when you buy the property, you at the same time is selling off the ground to a person that's giving you that amount of money for it. So it means that you will have somebody that you have to pay rent for the ground for, and that is the risk that you will have. So it means that you must just maintain the payment to the ground lessor, and in doing so, you then will be able to enjoy the income that is being produced from the building that's on the ground. If you don't pay the ground lessor, obviously he has the ability to take the property away from you, and that is the risk that I'm referring to.
Again, sorry for chipping in all the time, but I think what's something really interesting about the land lease is if you consider that that big bulk of cash we are paying effectively 3.5% for, whereas the investors we're paying 8.5% to. So it's very, very cheap money to start off with. The second thing perhaps we haven't added is that the ground lessor also keeps the banks honest. And we noticed in 2008 in the global financial crisis that the banks behaved very badly. They did capital calls because they revalued the building at a lower value, and then ultimately your exposure their exposure was too much. So they asked the owners of the buildings to put in additional cash, and unfortunately, that put a lot of guys out of their buildings. So with a ground lease, the ground lease has the ultimate legal rights to the property, and the banks tend to behave very, very well because the ground lease lessor keeps them honest.
Great. Thanks, Justin. What capital growth do you expect after a 5-year period, and what are you basing that on, given that you are not making improvements on the property during your investment period?
We are maintaining the interest rate at a fixed rate. That means that our cost of capital is a fixed cost of capital. However, we still have an escalation in the rental agreement, and the escalation in the rental agreements create additional net operating income. And as you know, the value of the building is determined by the net operating income in year 5, and therefore that is the gain. We expect to gain. Sorry, I just got a bit of an echo here. In the brochure, you can see the expected gain that we're getting from there. I think it's estimated that in a region of about 26–27%.
Thanks. Let me just scroll through here. Where does the surety sit within the deal?
The surety sits, we've got the ground lease, the surety is directly towards the property, so that is a asset-based surety. The senior debt, the majority of the surety sits against the asset, but there is certain clauses that takes care of negligence, and we call them basically the bad boy carve-out clauses, and that surety sits with our partner on the ground, Lincoln Harris.
In the brochure, it shows Orbvest gets 25% of the profit split and the sponsor gets 25%. However, is Orbvest not the sponsor?
We have made a co-sponsor agreement. So in terms of the property management and the overall setting up of the whole investment, we have basically set up a joint management agreement. They have the veto in regards to specifically items to do with the senior debt, and then Orbvest has the controlling vote with the investors based on the mandate for the rest. So we've actually set up a co-sponsorship in this specific deal.
Thank you. I'm just going through them. Sorry, I've got to scroll in between the thank yous and great tenant comments and why do you only focus on the eastern half of USA? Is there nothing in any of the other parts?
We have got a nice slide, which I think, Scott, if you can help me just showing that. Let me just get back to that, and I think that explains exactly why we're doing it. I just want to see if I got it. Yeah, I've got it. So if you can quickly give me the screen, I can show it, and that will hopefully explain to this investor what we're doing. One of the things that we found right from the beginning is that our property growth and ownership is really driven by population growth. And if you look at the states that we are in, is pretty much the Georgia state and the Texas state. We just recently did a deal also in New Jersey, which is about 16.7% growth. So we've been really focusing on the growth areas. And what we have also done is we're starting to look at Florida, and we're also starting to look at Arizona, Utah, and the Colorado states. So our strategy has not been driven to simply be all and end all in every state. It's really driven by a very strategic focus on making sure that there's population growth. And the second thing is that we also want to make sure that we are in states which has the landlord rights stronger than the tenant rights. For instance, in New York and some other states, some of the rights in terms of tenants are stronger than the landlord rights, and that obviously is a problem from an enforcement perspective when we look at long-term leases, etc. And then lastly, the CON states, or the certificate of need states, very specifically Georgia. Texas hasn't got certificate of need, and that has also helped us drive. And one of the areas that we are looking at the moment is North Carolina, South Carolina, and they've got very, very strong certificate of need. So these three factors, four factors, are leading us to decide where to go. And then once we know where to go, we then look for real partners that have got long-term relationships on the ground. We have fostered nice relationships over the years. And what happens then is we get access to the off-market deals, and that's why we've been able so successfully to bring these deals forward. So, yeah, it's a bit of a science behind it. It's not simply just saying, oh, I haven't been in that state, or I need to be in that state. It's really a very systematic approach.
Okay, great.
Yeah.
Do you want to add to that, Justin?
Yeah, I think again the purpose of the investment committee is very important here, because it's not a matter of just saying, well, that's a great state, let's go and find a building there. What process Michiel has had to do in the last couple of months is to actually motivate to the investment committee, first of all, can we go and look at buildings in these states? And you have got sign off on those 4 additional states, Michiel. So that's been a process which has taken you about, what, 3 months, at least 3 months to get them to agree to let you move into those additional states.
Yeah, no, it's a very systematic process.
Perfect. We've got time for one more question before we have to pivot. I know that there are a lot of other questions that have gone unanswered, but we will get the answers to you. We'll reach out to you directly. There are some answers we're going to have to get from Michiel and Justin, but we'll get those and pass those on to you as well. So for our last question, it's a general investment question, and it says, what will happen to the investments if the US dollar gets devalued because the Fed keeps printing money and the USA gets hyperinflation?
I got a great example of that. Scott, you obviously know that firsthand. We have a country just north of us, Zimbabwe, that has been in that situation. And if you have if it goes that way, obviously there will be a lot of other implications. But what we have seen is that the fundamental value of assets in real estate maintains their value. And if you have to buy them, you simply just have to pay more for them. So it means that if the underlying value is 40 million and the dollar gets half its buying power, hopefully you're going to pay 80 million for it in 5 years' time. So what we've seen is real estate in various countries where there were hyperinflation, they maintained their value even though the currency didn't.
And I think to your point, Justin, you said it earlier, you know, you made that comment, Warren Buffett said invest in something valuable in 10 years. And I think what's important here is that as long as there's a need for the asset, whether they pay in pigs and donkeys, Bitcoin or US dollars, they're going to pay because they're going to need it. You know. So Lee, what I'd like to do quickly is a number of people are saying, where's the brochure? And I've had one of those evenings tonight where, you know, I don't know why, but every time I shared my screen, it was blocking me out. So, I mean, literally, you go into wealthmigrate.com. You literally, I'm just going to do it live for you. You can literally log in on the platform, and once you go to the marketplace, you can go in and sign it. So I gave you the links, but it's probably not letting you in unless you actually signed in, because we're not allowed to just publicly make stuff available. So you literally go in, you log in, and then go to the marketplace, and May 27 is there. As I said, it's literally just been uploaded, I think, last Friday, in terms of where it is. So here it is, Richardson Medical 27, sorry, and you literally got all the information here, and then down on the right-hand side here, you can literally click on this link, and you've got the brochure with all the documentation. So in terms of the links and how to find it, you know, it's pretty easy. What I want to do is just pivot and to finish off. So really tonight there were two things that we were trying to achieve. The first thing was to get a medical update of what is happening. I found it really interesting what Justin said, that this is $1 trillion market, the medical space, and you know the inpatient rehabilitation is certainly a sector that they are really focusing on. You know, they spoke about what's happening with the current portfolio and the rental returns, which is really interesting in terms of the market, and equally where the world is going politically and economically, with tax efficiency in America, cost of capital going down, and obviously this is a sector where, you know, with the baby boomers coming in, that it becomes primary and important in terms of it. And the last thing is why this partner? Well, they've got hyper focus in the medical space. They then launched, and we had the privilege tonight of sharing with you Medical 27. It is by Orbvest. You can see all the details and everything that are on the platform. And so for those of you that are interested, you know, I always say that there's 6 things investors need: the belief, the knowledge, the access and the investment, the system, the support and accountability, and ultimately the results. And tonight was really about the belief and the knowledge, and you've also been given the access. You know, you can do it all on your own. You can try and fly to America and try and do it all yourself, or you can partner with people that have already done it and have a long track record of doing it. And, you know, a bird flying on its own compared to a bird flying in a flock can fly 70% further. And you know what's really interesting is that there's research out there now as investors that if you try and do it on your own, you have a less than 50% chance of succeeding. If you do it with a partner or a husband or wife, you've got about a 60% chance of succeeding. And yet if you do it with a like-minded group of people, like the people we've been talking to tonight, you've got a higher than 70% chance of succeeding. And that's why for us, what's really important for people that are starting out is that our inner circle is not just about the investment, but about education, community, and ultimately about purpose. And literally, you know, tonight is not about it. We can talk about it tomorrow at the at WealthE Wednesday. But if you want to get started from literally $100, you can now go and get started in a deal just like Medical 27. So someone asked the question, you know, they're talking about $5,000. It's very often for us that our partners have much higher minimums because that's what they're used to dealing with. They're used to dealing with high net worth individuals or institutions. And we've now got the ability for people to participate literally from $100. And for those of you who want to go to the platform, you literally can go to Wealth Migrate and get all the information. And then lastly, in terms of our wealth consultants, you know, I highly recommend talking to people. You know, we are a digital platform, but with a human heart, and it's about talking to people face to face. I know that tonight we've got David and Fritz that are actually online. And David and Fritz, I'm not sure if you guys have joined us, because what we've done, and Justin and Michiel, this is a new thing that you only seen before, but we've actually found that people love to be able to talk straight away. And so we've created 2 Zoom rooms, and Lee and I will stay here, you know, to finish up, you know, any conversation with the 2 of you. But basically, in terms of what we're going to be doing is that if people want to book an appointment, if it's too late tonight, they can go and book an appointment. The guys have actually chucked in a little chat box into the chat box. Obviously, if you're watching the recording, you know, you would have to go and click on the link below. And we're going to have 2 Zoom rooms. One is going to be for people that want to set up, how do I set up on the platform? How do I do my KYC? How do I fund my wallet? And the Zoom room is 701-502-3325. And for those of you that are actually wanting to say, right, Medical 27 is right for me, and I want to be able to invest in it, we're going to have a second Zoom room, which is 493-711-8843. And so David is going to be running room 1, sorry. Fritz is going to be running room 2. And, if you're too tired tonight and you want to speak to someone tomorrow, perfect. But we've actually found that more and more people from around the world want to participate right now, when it's available. So, David and Fritz, anything from you? I can see you've put the chat rooms up the links to the Zoom rooms up in the chat room.
Yeah, so as you said, it's there, and I'm more than happy to help anyone at this point in time. I'm in room 2, and I'm Fritz. I'll see you there.
Yeah, hi everyone. Thanks for the introduction, Scott. So what we're going to be doing is in room 1, I will be taking you through a setup and KYC tutorial, and in room 2, if you want, Fritz will be helping you go through Medical 27, explaining the fees and all the different things on the platform as well. So I'll see you there.
Perfect. And for questions like Johan saying, how does the model work, etc., I highly recommend people go directly to the room. If you've got new investors, it'll give you the ability to be able to participate. So that's really all from our side. I'll leave up those rooms. I just want to check here quickly, Justin and Michiel. I think we've answered all the questions that have come through. I'm just trying to see here, people asking about the link for the brochure. So that idea of mine didn't work clearly, putting the brochure up in the chat box. Just go to wealthmigrate.com and you can download it. When will Medical 27 close? The date on the brochure is the 1st of July. So the idea is a 60-day raise, May and June, closing on the 1st of July. Michiel?
That's correct.
Okay. Will the replay be sent out? So yes, definitely, including the 2 links to the Zoom rooms if people are interested. And yes, I think that is absolutely everything. So just from our side, one last thing that I think is important is that we have had a number of people say to us that they are interested in how do they actually participate and build a diversified portfolio at a global level, something that we're excited to be, medical, something like I said to you that I've liked for a very long time, something that Chad Pope and the guys have been working on with a structured note. And so, looking at a diversified fund, and Medical 27 is going to be one of our anchor within that. So it's watch the space, and we're very excited to have it. And there's nothing to talk about tonight, but Ray Dalio talks all about wealth diversification being one of the most critical things. And what we're really wanting to do is make medical everything we've discussed tonight, and how important medical is, but also being able to provide other fixed income opportunities. So that's all from my side. Justin and Michiel, my last comment to you is in terms of your experience over the last couple of years in the different sectors. I know, Justin, you started out as a property developer many years ago. What has been your experience over the last couple of years, primarily in the medical space? What's the one tip that you would share, Justin, from your side? And then Michiel, I'll pivot to you for the last question.
Well, I've got a very interesting story that many people don't know. Is when I was dabbling as a property developer, I built a medical center in Durban, South Africa. And I went there some 23 years later and discovered that the color of the walls inside, I remember getting them painted a particular color. It was the same paint on the walls. The tenants were predominantly the same tenants I'd put in. In fact, it was 26 years ago. So the same path lab, the same pharmacy, the same optometrist, the same general practice, practice. And that was a complete eye-opener for me. So you can say that I've got 26 years of experience in medical. No, not really. But I did do a medical building back then, and I think that absolutely underpins what we're saying here. 26 years later, the same damn tenants are there that I signed back in the day, before I had grey hair. So I think that sums it up for me, Scott.
Excellent. Thanks very much, Justin. Sorry, Michiel.
And from my side, Scott, as you know, we have looked at many asset classes, and there's very exciting types of investments to invest in. But you know, at the end of the day, you need a piece of your portfolio that is the steady eddy, rock solid, can count on sector, and this is really what the medical has proven to us over the last 7 years, and hopefully about a year from now we can look back at the virus situation, also say we went through that situation, and at the moment it definitely looks like it. So from my side, this is a piece of the real estate world that I think is steady eddy, and if you need a little bit of solid ground beneath you and sick and tired of the roller coaster ride, this is a place for you.
Excellent. No, well, thank you very much. Lee, from your side, thank you very much for putting everything together. Closing thoughts from you. I can't hear you, Lee.
Can you hear me now?
Yes.
I was so good at muting everyone else when they weren't speaking, and I can't unmute myself. Sorry, guys. So I think a lot of our questions that we've been getting since we launched Medical 27 last week have been answered, both on the medical industry in its whole and also on this deal. I tend to agree with your synopsis, Michiel. It is quite an exciting deal. So we did post in the chat box, if you want to speak to our wealth consultants tonight, those links for their personal Zoom meetings are there. Otherwise, please reach out to us. My details are on the screen at the moment. You're welcome to reach out to me and I can put you in touch with someone. We look forward to helping you on your journey and finding out whether medical is the right investment opportunity for you.
Excellent. Well, thank you very much, Lee, and my closing comment with regards to all this is that, having invested in houses and apartments on 4 different continents, and hearing Dolf de Roos many years ago saying that commercial property, and once you got into it, you never wanted to be in residential. And literally after getting into my first commercial property in 2014 and seeing how easy it was and the returns that I got, I just sat down and it was pure maths, like taking emotion off the table, and I just started selling off my residential properties because they didn't make me the same return and they had much more hassle. And that for me was my endearing story, and I'm just very grateful every day I get to share with others the ability to be able to participate in medical. So thanks very much, Justin and Michiel, for coming and sharing. We really appreciate it. We love what you guys are doing on the ground there, and look forward to allowing many more people to be able to participate in this opportunity. So thank you very much.
Thank you, thank you, Scott. Cheers, everybody.
Cheers, everybody.
Thanks, guys. And to our community, thank you for joining us tonight. We really appreciate. We know that we ran over, but I'm sure that you got lots of value. So thank you very much, and hope you all have a good night.
Thank you.
Thanks, everyone.